Is an all equity portfolio, all stocks, appropriate for you in retirement, in your 70s, 80s, 90s? New research, I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Traditionally, as you approach retirement and get into retirement, you should be taking less risk, or most people take less risk in their overall investment portfolio. Lots of reasons for that, but one thing is market volatility, right? When you talk about risk, there's all sorts of different types of risks, but in this case, you want to reduce the market volatility risk, and there's a few reasons for that. But that's the traditional approach, and so therefore, lots of debate on, well, by the time you reach retirement, should you be 100% in bonds? I would argue no, but you want to work with your CFP and build out the right plan. So I'm not going to rule that out, but I would say that's extremely rare. Should you be 60-40? Maybe. 60% stock, 40% bond? Maybe. What about 55-45, 50-50? Depends on your age. Should you be 70-30? We see that a lot. It depends on your overall financial situation, your comprehensive financial plan, within that, your retirement plan, and your overall investment risk tolerance. Well, some new research right here, linking it in the description below, from an associate professor out of University of Arizona, who says something different. He is saying they've done all sorts of research, and your allocation in retirement, throughout retirement, should be 50-50. That's 50% US stocks, 50% international stocks. That's right, 100% stock portfolio, 100% equities is what they're saying, several years, rolling time periods stacked on top of each other suggest that is the best way to invest in retirement. So would you do it? Is that appropriate? Here's the thing, guys. This is not a surprise at all. The numbers can't be wrong. I haven't checked them. They can't be wrong. But here's the idea, and he states this in his research, that yes, stocks are volatile. However, after they go down, they inevitably recover, and over the long term, stocks for the long term, that phrase, stocks perform better than other general investment categories. It's certainly better than bonds. That is not a shocker. That is absolutely accurate. No one should be surprised by that. If you're surprised by anything, it's that he's saying a 50-50 between U.S. stocks and international stocks outperformed 100% U.S. stock portfolio, certainly with this past 15 years where U.S. stocks have been dominant. But the simple fact that that stocks outperform bonds over the long period of time, that is Captain Obvious. Of course they do. And so his research is saying, listen, stocks will be more volatile, they'll go down, but then they will eventually recover and reach all-time, new highs on a consistent basis in a timely fashion. Bonds, however, even though there's less volatility to them, in the rare pockets where there is volatility, he's saying they don't recover the way stocks do. Well, of course, that's also obvious as well. Bonds are issued at one price. They can float in value between when they're issued and maturity, but they mature at the same price. They don't mature at a higher value. We should expect today that the world's greatest enterprises are worth more today than they were worth 10 years ago. And yes, there's market volatility, so there's times when that's not true, but over time, that should be the case. Not with bonds. We know it's contractual. Over time, they will eventually be worth what they were worth back when they were issued. So not a shocker. So should you follow this? Should you be 100% equities? At the end of the interview, he's asked, well, so, is this early in retirement? Do you make changes? And he says, no. The way that they've modeled, 100% stocks in your 70s, in your 80s, in your 90s. Here's the problem. In reality, this breaks down, okay? In reality, this breaks down. The numbers aren't wrong. The approach, the idea isn't wrong. In reality, though, market volatility, especially in retirement, is extremely hard to stomach for the average person. Therefore, if you've worked your financial plan and if you've got strong resolve and can resist the urge to make big adjustments when you see your portfolio shift, this might be appropriate for you. It might be. Then you've got to be aware of sequence of return risk, which don't have time to go into fully right now, but essentially if you over 10 years, if the average returns from two different scenarios are the exact same, the portfolio will turn out to be very different if the beginning, if the start of those 10 years are negative years in the stock market and you're drawing money out, and then later years there's greater return. That's when the markets recover, but you have fewer dollars because you've been drawing them out. You end up with a much lower portfolio than if the exact opposite occurs, where at the beginning of those 10 years, you have very strong investment returns. It's the later years that aren't as strong. Same average return, very different portfolio outcome. Therefore, when you're in retirement, it's not prudent to have so much of your money that you're using in the short term at risk in the stock market. Again, you've got to work with your certified financial planner, and there is not a one-size-fits-all approach. However, we strongly suggest, and how we help our clients as they approach retirement and are into retirement, on figuring out the right way to stratify their investments and invest for retirement is to build out something we call the personal pension plan. And that is aligning your dollars and the investment strategies with the time horizon. When are you going to need them? The dollars that you need in the first 2 to 3 years should be low risk, or the dollars you need in the next 2 to 3 years should be low risk because you have a short time horizon. Very possible that we see in the next 2 years stock markets the stocks be lower than where they are today. Therefore, having a couple years of low risk dollars so that you don't have to worry about your spending level and withdrawal level, that tends to be appropriate for the next 5 years or so. So from years 3 to years 7 or years 8, those hopefully are income producing investments. And you might have some stock or some high dividend investment. We've talked about that on the Wise Money Show before. That might be embedded in here, so you're still getting some capital appreciation. Could be a bond ladder, CD ladder, something like that mixed in as well, but something that's generating income so that as you spend through that first bucket, those first 2 to 3 years of cash, you can replenish those dollars either with income or with maturing securities. And then any dollars that you don't need in the next 7 to 8 to 9 or 10 years, depending on your situation, that should be long-term. Those are long-term dollars. They should be invested for the long term, and that should be, I would certainly comfortable with 100% stock in that, for that kind of third bucket, that long-term bucket. But it's up to you. What's your temperament? Because even if all the math and all the studies say you should be 100% in equities, if you make a decision at the wrong time to say, I can't handle this anymore. My investments, my portfolio just lost 30%, 35%. I can't stomach that. I can't do that. There's no way I'll be able to survive retirement if this doesn't recover in the short term. And that's when you choose to get less aggressive and get out of the market. That can make a permanent issue and create a permanent challenge with your portfolio and with your retirement plan. Therefore, stratifying it through this personal pension plan, those 3 different buckets, and having that last account, that last bucket be your long-term dollars, but still invested for your overall risk tolerance, that is what we've seen be most appropriate in how you should invest in retirement. Work with your certified financial planner on that. This decision of how should you invest as you approach retirement certainly won't argue that 100% equity portfolio that's diversified is appropriate for most people. Absolutely wouldn't argue with that. But making that decision, that investment allocation decision, Kevin Korhorn has said that's your biggest financial decision that most people will make in their life is your investment allocation. But then as you approach retirement, as you get in retirement, then how do you structure your investments? Do you make tweaks and how do you build out that personal pension plan? Work with your certified financial planner on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.